Welcome back to the Personal Finance Project. Today, Scott and Greg will be doing another installation of our financial myth-busting segment. Today, we are debunking the myth that you can determine the right percentage of equity for your portfolio by simply subtracting your age from the number 100. Scott, does this formula ever make sense?
Yeah, I would say that there's one situation where I like it as a rule, that would be the day that you're born. And the reason for that is you're not particularly bothered by market volatility or what's happening in the news when you're in diapers, and you're completely unaware of what's going on. But in all seriousness, I think there's some problems with this particular myth, because what it tends to do is, I think that for the vast majority of your working life, it's a little bit too conservative. Because as we've talked about in the past, we're always going to counsel somebody who's thinking about starting investing to have, an emergency fund and some ability to cover things that come up with the car and the house, or, needing to move, those types of expenses. But if beyond that, and say what we call your investable assets, if you have a good job and an emergency fund at 25 years old, I'm not going to counsel somebody to own bonds, because I just think that what you're giving up is total return for the sake of some short-term semblance of safety. Greg, what do you think?
Yeah, and I think that the real issue with this myth is that people take it literally, but not seriously. And so what I mean by that is, when people hear, hey, if I just take 100 and I subtract off my age, or if I just take my age, that will tell me how much fixed income I ought to own in my portfolio. And they think that they will own this independent of all the other variables in their life. So as you mentioned, when we're working with a young person, we like to see if they've got a family, if they've got dependents, that they're adequately insured. That would be on the life insurance side and on the disability side. And that's because that is providing protection for the vast majority of their financial capital, which is tied up in their ability to continue to earn an income.
Yep.
And so people will tend, when they're doing this analysis, or I would say investing in the style of this myth, they'll ignore these other variables. So like you mentioned, if you've got a stable job, if you've got your emergency fund set up, and say 3 to 6 months expenses is like the typical tool, you could go a little bit more than that, and it's not going to harm you. Now, when we're talking about distilling down just your actual investable assets, the things that you are presumably putting in place to grow for, say, your retirement, or for some goal that's off in the distant future, down payment on a home, maybe 10 plus years out, it doesn't really do you any good to then layer on top of your total portfolio more fixed income investments. So it has this weird property, this myth of being kind of vaguely correct, whereas we talked about with the 60-40, it's probably never going to harm you that much in any particular instance, but it's probably also never exactly right for your condition.
Yeah, and I think, I think generally, if what you're getting out of it is you can be a little bit more aggressive when you're 20 versus 50,
right?
I think that's right. So that, like you said, it's generally right.
Yeah, directionally
right. But I would never actually put pen to paper on my investments to compare them to what that number comes out with.
No.
Say when you're 42 years old, check to make sure you're at 58%. That's probably too conservative, for one. And I also just think it isn't very helpful in determining whether you're on track towards, say, a retirement at 60 or 65, something like that.
Yeah, and I think that we could add to the allocation is appropriate on the first day that you're born, and maybe on the day you leave your employment. So it's possible based on your age. So if you retired at, say, 65 or 67, probably still a shade too conservative for most of the people that we work with, but you're in the general vicinity of where you might be. And again, not to give too much away about how we invest our client assets, but when we're looking at the arc of risk over the lifetime of a typical investor, and then the arc of this myth, they do intersect at a couple of spots, but it's entirely coincidental. It's not because this is a really great way to invest money at all stages. It's just by chance that the actual way that you should invest money should be, you want to have an allocation that is appropriate for the risks you are currently facing, not because somebody somewhere said, invest your age in bonds.
Yeah, and I think, one specific aspect of that is, I think we need to differentiate. Maybe if we're thinking about this myth, if we're talking about a situation where you are inherently depleting your capital, where you retire with an amount and you know that you do not have enough money to maintain that asset level or grow it in retirement, and we're just talking about trying to hold on as long as possible, then I think the myth is going to be a little bit better. Because in that scenario where, say, when you're 82, you're worrying about running out of money, you actually probably do need to be pretty conservative, because you can't, you cannot shoulder the risk of market volatility if what you need to spend is, say, 9, 10, 11% of your asset base, where that's a little bit too high. I would say for a lot of the people we work with who retire and what they're going to need to spend from their portfolio is maybe something in the 3 to 5% of their asset base range. I think as you get older, it's going to get further and further away from the truth.
Yeah.
Because, as you said, the risks are declining if your asset value in comparison to what you're going to need to spend going forward is not declining.
Yeah, and I think when we're talking about like where the myth and the arc of a typical investor risk intersect, and then where they diverge fairly widely, would be, I would say, beyond age like 75 for sure, maybe even slightly sooner than that, because for whatever reason we've crossed our, I think people got this a little bit incorrect, where they've assigned time horizon and they've known, and this is a first principle in investing, if you have a very short time horizon, you don't want to expose those assets to market risk. Like if you were going to buy a house next year, you wouldn't put all the money that you were going to use for your down payment into the S&P 500 today. That would not be sensible.
No.
But if you're 95, that doesn't mean that if your life expectancy at this point in time is, say, a year, that your investment risk is the same as a person who's going to buy a house a year from now, because your assets are going to extend well beyond your life expectancy. So I think that this sounded really good because people assign time horizon to the human being and to the assets, which would convey, hey, as you get closer and closer to when you're going to leave here, you should be getting incrementally more conservative. But if you just think about that for a second, it really doesn't make a whole lot of sense.
Yeah, if your assets were concerned about whether you were alive or not, then yes,
right.
Maybe that would make sense.
Right.
But
or if there was or if there's some like 100% inheritance tax or something, it might convey but even in that case, it's like it's just going to the government, so who cares?
Yeah, I mean, maybe there's some planning to do around it that could change your allocation. But yes, you don't need to be thinking, all right, this has got to be cash for my heirs. I mean, maybe there's a situation.
Tax bill.
Yeah, well, if there's a tax bill, or for a fact that they're going to need to spend a ton of money as soon as you pass away. But my feeling working with a lot of retired people is, if your kids are in that dire of a financial condition, you're probably helping them while you're alive.
Yeah.
Not just thinking, all right, well, as soon as I die, they're going to spend their entire inheritance.
Right. And I think that kind of leads us into the conversation on how we would regard risk and how we would regard an appropriate asset allocation. And that generally means the time over which, or the time period between when we're going to make the investment and when we will need to turn an investment to cash in order to consume it. So it's not saying we might turn this to cash later because we're worried about the volatility in the market. That might happen. But we really would look at an investment and say, all right, when do you want to turn this pool of money that we're about to put into whatever we're going to put it into cash that you're going to spend? And that's why, like we talked about, at retirement, where you're maybe at the peak risk, this myth might work. If you retire at 50, a 50-50 portfolio might actually be a little bit more aggressive than you would want to be. But it really diverges greatly from there because, like we talked about before, the risk stops following the allocation.
I agree. One thing that I do want to kind of talk about a little bit, that I think if we consider ways where this myth maybe could be right, so to speak. One thing you might think about is the historical divergence from equity and fixed income that we've experienced over the last, say, 20 or 25 years, is that durable, or do we get an allocation or a performance stream maybe more like what happened from, say, 1970 to 2000?
Mm-hmm.
And I think what you'd find over that time period was Stocks did about the same. They probably did 9 to 9.5% over that 30 years. But fixed income did significantly better because interest rates were higher. One of the conversations we have with a lot of clients today is, are we entering a higher for longer interest rate environment? Where I'm not saying necessarily that rates are going to go significantly higher from this point, but do we not get back to the kind of post 2008, 2009 zero interest world where the 10-year yields 2%? I think that's a pretty reasonable case. And if that is the environment we're in, I still think the myth is busted, but we have to consider, all right, is the historical divergence between bond and stock performance going to be a little tighter over the next 20 years versus the last 20 years?
Yeah. And I think as financial advisors, when we're structuring a portfolio for a client, whatever their age, we can be somewhat asset class agnostic at the beginning. Obviously, you and I both know asset location will kind of dictate how much of your fixed income exposure you should own and where. And if we have enough assets that are sheltered in maybe in an IRA, a little bit more appropriate for the retiree to own bonds there. But if bonds are going to be a meaningful contributor to total return over the next 10, 20, or 30 years, then there is a case to be made about owning a little bit more fixed income than you traditionally would, not for the safety purposes, but because this is an asset class that has gone from doing virtually nothing for you, basically from, post-financial crisis until when interest rates have finally come back up, to being a meaningful contributor. And in that case, I'm perfectly happy to own bonds, even for a person where we would originally or traditionally have been like, you just don't really need to own fixed income,
Yeah, and I think asset location in this conversation is very important because if you think about, say you're retiring and you have $1 million and it's 100% in a 401k. In that scenario, I think that, like you mentioned, right at retirement, it might be about right, and then it probably skews where it's the myth would get you too conservative too quickly. In a scenario where, say, you've got assets evenly split between a traditional IRA, a Roth IRA, and after-tax money, what you might look at is say, all right, the IRA, maybe I'd be more conservative than this, because one of the things that we talk about with clients frequently is the traditional IRA/401k. The one thing I can guarantee you is that all of that money will be exposed to tax during your lifetime plus 10 years.
Yep.
And well, I guess your spouse's lifetime plus 10 years if you're married. Right. But we know for a fact that this money has to be turned into tax. So if you have multiple pools of capital, where does it make the most sense to be the most conservative? One where you have to turn it to tax or into income, as opposed to places where either A, you get a step up in basis and an after-tax account, or B, in a Roth where you get tax-free growth even beyond your life expectancy.
And I think that this really is the problem with the myth, is that it is so complicated by all these other elements of financial planning, where it sounds like we talked about in the beginning. It sounds vaguely right. If you're 25 and you have 75% of your investable assets in the stock market and 25% in the bond market, are you going to significantly harm yourself on the front end? No. And you'll probably do okay. But as you incrementally start sheltering more and more of your assets from the productive capacity of the stock market, that's where the insidious kind of type 2 error starts to rear its ugly head. Where in the short run, you might say, well, I'm investing quite wisely. I'm following this rule where however old I am, that's how my allocation is to bonds, and my volatility in my portfolio has been going down over time, and I feel pretty good about that. But what you don't see is missed or returns you didn't get. And those are the really difficult elements of life to examine because they're kind of off the screen. It's like, I'm not even playing this game, so I don't care if I'm losing, I'm not playing. But for being prepared for retirement, an under allocation to the stock market is probably a more pervasive problem than near-term volatility. So if you're suffering near-term volatility, that doesn't indicate that you made an incorrect decision. It's just saying probably looking at your investments every day isn't very good for your mental health.
Probably not.
But it's also saying you've got all these other sources of income as a young person and in retirement too with Social Security that we need to consider as part of the analysis. If you're in a fairly stable job and you've got your emergency fund in place, your human capital component of your total financial picture again, is the biggest piece of the puzzle. Whatever it is that you're going to earn from now until when you retire or when you stop earning an income, that is a huge sum of money. And when you're young, the sum of money you actually have invested is probably, it's a tiny fraction of what we're talking about here, which tells us you can probably expose 100% of that for a long time until you're nearing retirement to market risk, because you've got these other sources that you're going to be paying your ongoing obligations from.
Yeah. And as a final thought on that, another thing that I'd just like to posit as a reason that this is going to fall into the busted camp is that inherently what we're talking about is a glide path where you're going from more aggressive to more conservative. So what's going to happen is that you're constantly needing to take equities off the table and add them to fixed income. Because equities tend to perform better over time, this is a process that if you're really kind of devoted to this idea, you're having to take, pretty regular action to pull equities off of the table. You're rarely going to be, say, moving money from bonds into stocks.
Right.
What tends to happen, and I would guess, is that if you are, say, a really devoted, participant in this strategy, what's going to happen is when the market's shaky, you're going to want to make moves into bonds. And when the market's doing well, you're not going to want to make those choices. You're going to want to let it ride when it's doing well. When it's doing poorly, you're going to take stock off the table and add it to fixed income to get back to this 100 minus your age allocation, which means you're probably, again, hamstringing your total return by a few more basis points or tenths of a percent.
Exactly. Yeah. So again, I think that if we had to put a pretty bow on this myth, it's vaguely right, but I think specifically wrong. It might be appropriate at 1 or 2 points in a person's life, but beyond that, it just kind of, it doesn't pass muster.
Yeah. It's kind of like, what is it? The tangent graph, I guess. It gets very, very close to,
but never
correct, but it doesn't quite touch correct.
Exactly.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. The broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.